Joined by my colleague today, Albert Marquez, AM and AM and the PM here today. How is your afternoon going so far there, Albert?
Hey Andrew, so far so good. Been a busy day thus far, but I agree with you. This is a fantastic class, and really one of the things that sticks out to me most is that when we talk about technical analysis, we always say there's a bit of an art to it, right? And especially with considering we've got 12 different guys here on the team, and if you show us one chart, you'll get 12 different responses to it. But and I think that the thing about it being an art is that if we can come to an understanding about certain patterns, then that kind of brings things together for everyone, so we can definitely see some commonality with regards to some of these patterns. So yeah, happy to be here. Excited to be getting into this information, and should be a good one tonight.
Yeah, I couldn't agree more. Heck, if you ask 12 of our guys, you might get 13 different answers. So who knows how crazy things can get when it comes to technical analysis. But nonetheless, I would say that even if we are applying some sort of lens of subjective nature of the market, we can at least kind of paint a story of why that is important. We can paint a story of if this price gets above a certain level or it gets below a certain level, well, you can imagine that kind of abstract concept of a trader out there who's going to be forced to make a decision at that level. And that's the importance of technical analysis. Is important junctures on the market where you anticipate buyers or sellers being forced to or kind of given the ability to make a decision accordingly at those levels. And when it hasn't done that, well, maybe the people are just simply waiting. But I do want to at least kind of talk to the understanding of these patterns and their limits at the beginning component here. That what is a pattern? How do we actually define a pattern? What has to be bounded by at least two trend lines? And when we say trend lines, that doesn't necessarily mean a diagonal trend line up and to the right or down and to the left or to the right as well, not going backwards in time. But the pattern itself is simply looking at some sort of combination of those lines. It can be horizontal, it can be diagonal, it can be curved technically if you're using some sort of dynamic trend line. But ultimately, there is an entry point and an exit point. The patterns themselves have a breakout. The breakout is the important component of that pattern in particular. And that's what we're looking to see. Is it going to have a reversal breakout? Is it going to have a continuation breakout? We're simply waiting to see that activation due to the breakout itself. But this is kind of like what we were saying, the subjectivity component. All of these patterns are built into the natural bias we have as humans. As humans, one of our, evolutionary perspectives is the approach to try to find patterns when they are out there in the marketplace. Finding which berries are delicious versus which berries might be dangerous to us, trying to find patterns that are out there. It's innate to us as humans. And the issue to us sometimes is that we look either for patterns that might not actually be there, or sometimes we look for patterns that simply confirm our original bias. And that's something we always have to try to be as objective as we can with this subjective analysis that we are using. So, like we mentioned, there is very much an art to this, and there's that component of trying to remove the human element to the best of our ability. We'll look at theoretical calculative price targets of these breakouts and these patterns as well, and that's sometimes its own type of bias. If you saw a breakout that, if it gets above $50, by calculation, it should go to $60 and it goes to $58, well, you had a pretty good trade. Simply waiting for it to get to $60 starts to bring more risk into the scenario. Maybe that's another issue that we have to think about as individual traders and making sure we're trying to be as unbiased as possible. So, a question coming: are these slides available? They technically are. They are part of week 4 of the technical analysis classroom session. So on fidelity.com/classroom, this is a downloadable slide deck that you can look at on the website as well. We will try to show that before the end of today as well. But how do we then use the actual techniques for trading patterns out there? Well, again, we're looking for some sort of breakout. So the breakout itself is that validation versus invalidation of a trading thesis. So maybe we use entry stops, maybe we use protective stops, but maybe we wait for a retracement of that. But more specifically, what is a breakout? Well, theoretically speaking, in a very kind of bare bones scholastic sense, if we see something break above resistance in this, say, example, that is a breakout. Say if this was a $100 level on the chart, you had seen it get to $100, sell off to $90, and then get back to that $100 level. Well, that's a breakout that is being found. We broke out above $100. But the issue is, how important is that individual breakout? We have to create some sort of filter process for that in particular. What do I mean by a filter process? Well, if you've ever traded breakouts and things to that extent, you've probably seen false breakouts, failed breakouts, which we'll look at as well. So we want to create some sort of at least confirmation system to say that there has been a breakout that has happened on this one. One could just simply be if it gets above, in this example, $100, that's a breakout. If it got 100 that broke out of $100. Maybe though you want to see it close above $100 on a daily or hourly or weekly perspective. Maybe you want to see it stay above $100 for maybe a defined period of time, or maybe get 1 or 2% above $100. Is not a correct answer to this. That's the unfortunate subjective nature of this. The issue is that, say if you were trading on this basis, that if it gets above $100, I think it's going to go to 110. So there's a 10% potential reward for this trade to take place. Well, if you just wait for it to get right above 100, it might fail right below that and it might come back down. You might be in a trade that you didn't want to be in and lose. So if you have to wait till it gets to 101, 102, well, we're just eating into the potential reward that we had already sought out. And that's the natural gimme and gotcha, the tug and the pull of the situation. The more confidence that we have in a position, the less reward it might end up being, because we had to wait for more and more confidence to work out in our favor. And we lost out on some of that opportunity cost. But if we got in at 99, it may not have broken out upon 100 at all. So that's the interesting kind of thread of the needle here, is we're waiting to find some component of a confirmation filter. Every trader is going to be slightly different in that respect, but we can use what are sometimes called entry stops in that respect. We have a buy stop order. If you've ever used stop orders, you probably were thinking, why would anyone ever want to use a buy stop order? Because if we think about what the logistical nature of a buy stop is, well, it says, hey, I only want to buy this stock or underlying or ETF if it gets to this price or higher. And you were thinking, well, if you could buy it for less, why wouldn't you? Well, part of technical analysis is sometimes waiting for those breakouts to occur, that if something never gets above $100 in this example that we've now used multiple times, well, you're thinking, well, if it doesn't get above that, it might not go above that. It might just keep going down. But if it gets above $100, that means that there's been enough demand to get us past 100. It may keep going up. So as a buy stop order, it's essentially waiting for that breakout to occur. But like we mentioned, the main issue, the main risk that you have as a breakout style trader, whether that's patterns or whatever you're looking at, if we're using breakouts, is the idea of a false or a failed breakout. And that's the biggest thing we have to keep in mind, is that just because we'll look at all of these different patterns here today, just because it breaks out doesn't mean it has to go and complete that pattern. It does not mean that the next price is going to be higher or lower or relevant to it. It is simply a way of looking at it through that lens of probabilities. You know, at current moment in time, if you threw a dart at a Wall Street Journal and you bought whatever ticker symbol it landed on, you would think theoretically there's roughly a 50-50 chance it either goes up or down. What if we could create some sort of system that gives us a little bit better of an edge? What if a breakout of this pattern lends itself to 60% of occurrences on a bullish perspective? It doesn't mean that you're going to win those trades. It just means that you have a slightly better edge than 50-50. And that's sometimes what we're ultimately trying to look for as traders, is something that just gives us a little bit more confidence in the trade that we are placing. And then as traders, if we are using that breakout as a concept of our bullish or bearish thesis, what we have to then also keep in mind an invalidation of that bullish or bearish thesis. If it gets above a certain level that was then validating our bullish thesis, if it goes back below that, well, our thesis should become invalidated. That's something I think some traders have a hard time doing from time to time, is they get in a trade and they say, hey, if it gets above $100, I'll be a willing buyer. Gets above it and then gets back below it. And now they're thinking, well, maybe I'll just wait. It can keep going up. And that's the big thing we always want to keep in mind as traders across the board, is having some sort of level in mind where we no longer feel as bullish or as bearish about what we are seeing at that moment in time. I'll grab this or move the screen to another name that is, I think, a good example of a now infamous failed breakout, the Russell 2000. If we go to this time frame in particular, in fact, let me zoom in on that side and we'll even make it a daily perspective. What did we see for a lot of this period of time, 2021? Sideways price action. In fact, sideways price action between about 2050 and about 2350, a fairly sizable 10% range in that respect. Bullish traders finally got what they were waiting for, got us above 24 or 2350. We spent what, 3 or 4 days above that before getting to this level one more time, creating that failed breakout. And now you're thinking, well, yeah, I did wait to buy it at 2350, but you know, last time it got down to this point, it bounced at 2100, 2050, whatever we see here. But now the issue is that there were some traders who are now stuck in this position. I mentioned this earlier, that we can create a narrative of what traders are doing based off of this price action. Imagine you have been a buyer at 2350, you saw it get below that, and you're thinking, well, as long as it bounces at 2100 where it's bounced in the past, maybe I'm willing to keep that on. And when we got down below that, we essentially created an entirely new distribution to the downside, because where people were once willing buyers were becoming forced sellers. And that's an important distinction of lines in the sand and components of things that we want to make sure we understand from the risk perspective. What I generally like to say when we're looking at, say, charts like these, or, I don't mean to pick on the system that we are using to actually broadcast this webinar here today, but imagine you have been a trader on Zoom video for a bit of time. It moved from a very low price, $60 or so, all the way up to $600. And imagine being a buyer somewhere along the way here, that maybe you're thinking, well, if it gets below 450, I should probably sell it. But then it gets below that and you're thinking, well, maybe if it gets below 350, I should probably sell it. And then all of a sudden 250. And then all of a sudden we're now back below its pre-COVID price. How many traders sometimes get stuck in a position like this because that line in the sand that they made, they just simply created a new line after it crossed that level. I always like to call that the Yosemite Sam strategy that we're trying to avoid. If we remember the old Looney Tunes, he would draw a line in the sand, dare Bugs Bunny not to cross it. And then when he did, he would just simply draw a new line in the sand and do that over and over. And then all of a sudden, Yosemite Sam falls off a cliff. That is what we are trying to avoid as traders. We are trying to create levels that we want to manage our risk in the most effective manner. So if we think about it through that lens, there's a variety of different components that we can do that, but always keeping in mind where our bullish thesis no longer is valid. And again, what can we use from that perspective? Protective stops is one way. If we think about a buy stop order being this component of, if it gets above X price, we want to get out of it. If it gets below X price on the sell stop, that is also where we are wanting to protect our overall position. We can use that for both regular false and fail breakouts, but also just something to keep in mind at all points in time. And also keeping in mind, sometimes that flip of support to resistance is an important component of the market, where once we found support at this level, people were willing to buy. Do they then turn it into a resistance level where people are willing to sell? So I know I've been going for a handful of minutes. Anything you wanted to add here, Albert, or anything you want to take a look at as we look at the next chart patterns?
I think there's a lot of good stuff there. And as you were saying before, there's definitely an art involved to this, right? And the one thing I always want to make sure that we remember when we're thinking about the elements of all these different types of charts is that it may not be a straight understanding of what that level is. In other words, we might not just be able to draw a straight horizontal line and say that this is the level and this is my hard and fast stop, or whatever it may be in that particular instance, right? It might be a bit of a zone. I think that's only become even more evident over the years as algorithms have gotten involved, and the idea of triggering these types of reactions by hitting a certain price will do so. And so I think that even more so than ever, we have to be more, not necessarily as exacting with our levels, but a little more giveaway will help us be more effective traders. In other words, we might say it's 100, but really it might be 100 to 103. And so therefore we can try to help eliminate some of those false breakouts and some of those traps that might be waiting for us. So don't think that, just because these simplistic charts that we're showing you have these exacting lines, this is really for demonstrative purposes only, right? Very rarely do things play out like this in real life. So just be aware of that and understand that there's not always going to be an exact number that you can adhere to. But let me give you a quick example. I'll grab the screen real quick, Andrew, just to kind of show what it is that I'm talking about. And I'm going to use one of the examples that was given by one of the members here, and they were asking, hey, can we take a look at AVGO if you get a chance? And I backed it up and kind of giving you an idea of what you might be looking at with one of these charts, or one of the little bit of this information that we've been talking about. And that is, we've got this, we'll call this is actually called a ascending triangle, where we've got this kind of horizontal zone and higher lows on the bottom side. But again, you can see, I'm not saying, oh, it's got to be this close or it's got to be this close. I'm saying it's somewhere in this range is the level that I'm looking for. And as you can see, as we get move further in time, it acts as a bit of a resistance zone a couple of times, right? It gets right to the edge. And then it tries to break through and goes to the top end of that particular zone, and now it comes back down. So this might have been a breakout that you might have seen as a signal, only to see it's a false one here by going a little bit further. So again, the zone can kind of help get rid of some of those false breakouts or some of those readings that might be a little ambiguous. And as you can see, it goes back down again, but still maintains the trend line. And next thing you know, we've got this candle here that actually is outside of the entire zone. This might be that breakout that you're looking for. So maybe you take a long position in AVGO once you see it's outside of this zone. And of course, if we go to where we are today, you can see how that would have worked out for you, right? Now, obviously, this is an extreme example. And again, it was brought up by someone in the audience as something to take a look at. So that's what I was doing, not trying to pick this out and saying, hey, look, these things work all the time, right? That's definitely not the case. But my point with being is that if we use these types of zones, it'll help us a little bit with some of those false breakouts. We're still going to get those, right? We'll still find those types of elements with charts, but at least in the shorter term, maybe it can help us not to get caught in some of the kind of backwards, or I should say, side to side noise that can sometimes be in charts like this. So that being said, let's go ahead and I think probably now, Andrew, we can move forward with talking about some of the construction of these particular patterns and the charts themselves. When we look at common chart patterns, we can kind of break them up into these three different types of patterns. So we might have multi-bar patterns. And again, if we're looking at multi-bar, we're really talking about, candlesticks or really open, high, low, close type of situations. We're not really necessarily looking at you could be looking at a line chart, but remember, the line chart only gives you the close. It doesn't really give you the full picture. So that's why I think typically we'll be using candlesticks, and that's typically what we refer to with regards to the demonstration and the other materials. But we could certainly look at congestion, right? Horizontal congestion. That might be a double and triple top or bottom. Rectangles, as Andrew was showing us with that rut chart, right? That would definitely be a rectangle situation going back on rut. Triangles, as I just showed you, an ascending triangle, symmetrical, can be with both slanting towards a point at some point in the future. Descending in wedges as well, different types of patterns. Of course, probably one of the most famous would be the head and shoulders pattern. And you have that cup and handle, which has a slightly different feel than a straight line, right? It's using more of a curved kind of area on the chart. If we talk about candlestick patterns, when of course this is a very small sampling of candlestick pattern, there's many, many more beyond this, but some of the more popular ones, Doji and Harami and Hanging Man and Hammer, all giving us indications of potential changes in trend when things might be coming to a head, right? Getting ready to make a different type of movement. Because again, remember what the goal is of technical analysis. It's to identify a trend early enough that you can ride it and take part in that trend, but also understanding when that trend could potentially be ending. And so candlestick patterns are often used quite a bit for that type of information. And of course, short-term patterns, right? The pennant and flag that we often see, those gaps, which we can see on just about any chart. A pipe bottom is more of a open, high, low, close type of pattern, and of course, a narrow range. So let's kind of dive in a little bit further here. Let's talk about that double top, this congestion. So really, when I look at this particular pattern, to me, it's like a battleground, right? In other words, we've got this sort of area where maybe buyers and sellers are kind of battling each other to see what the next level might be. And as we go back and forth between these 2 points, the momentum shifts between those buyers and sellers, right? So we've got two successive peaks separated by an opposite reversal point. So if you take a look at this particular chart, you can see we've got our peak here and our peak here, and this would be that opposite reversal point. So we enter in this particular one, we enter from from below. This is a double top, right? We enter, we hit that resistance line, we come back and hit it again. So now we have our double top. Now the next thing we're looking for is, does it maintain this particular support line going forward? And of course, we'll have to try to determine what constitutes a breakout, whether it be a certain range away from a certain percentage. But of course, we always have to watch out for what is this, right? Those false breakouts as it works its way back to that support line. But as Andrew pointed out previously, what do we often see when we see support lines broken? Well, they turn into a resistance line, and very much so. This is what we're seeing here. It breaks through, and now we have a resistance point, and now potentially moving lower. So that would be a double top, and you can see in this illustration as well. Again, real life is not quite as simple as this. But you can certainly make out areas on here where you can make that double top pattern, right? We move in from below, we come in and we hit that resistance point here, back down to that support, back up to that resistance, and now here we are again. Now we have to make a decision. Now, this particular chart is an interesting one because had you maybe reacted on one of these particular lines or these candles, maybe you were thinking that this is going to break out lower. If you did, you got, I would say, kind of lucky here because the gap between these two is pretty significant, right? I mean, although it is a $7 down to only 650, that's a pretty sizable gap to move away from this particular pattern. So just keep in mind, regardless of what pattern we're talking about, we have to keep in mind the idea of making sure that signal is accurate, right? Getting confirmation of what it is that we're looking at that particular point. So if we want to calculate the price target, we would simply take the height from the highest peak to the trough and then subtract that amount from the breakout price to the downside. So in this particular example, if we're looking at this, I'm going to say it's about 770 down to, we'll call it right about, we'll call it 710 roughly, so 60 cents. So if we break out from that particular level, I'd expect 60 cents lower, so somewhere around 650-ish. And what do you know? We get down to about 650 and actually then some, right? And so we start to move a little bit further beyond that. So that's how you would work that particular pattern. What happens if we get to 650 and you still think it's going to go lower? Well, we can certainly use other ways to control that as well. We can use a trailing stop that'll follow it lower, but not ever adjust. So therefore, if we continue to move lower, you can continue to participate that. But if it starts to backtrack, it'll get you stopped out. So there are ways to go ahead and stay in that pattern if it goes beyond what you originally thought and you feel like it has more downside to go. If we take a look at the double bottom, so this is really kind of just the reverse of what we just talked about. In other words, we're entering from above. We make that initial touch on that support line, then we hit that resistance line, and once again that support line. And now we're looking at this potential double bottom and that trying to get that breakout. Once again, seeing that the resistance line, once it's broken, turns into that support line. So we had this movement out, a false breakout, a little bit of a throwback, and now we're watching to see what happens here. Do we wait for this to move beyond this first breakout level? What is going to be our signal for entering this and getting ourselves confirmation? So again, not quite as clean in the real world, but nonetheless, you can see that pattern forming, right? We move through, we'll call it roughly 41, just to make it simple, down to about, we'll call this about 32 roughly and then back down again to 32. Now we start to see it move back up again. Does it break out? It does move beyond our initial level of resistance, which now becomes potentially a support line. And maybe we look at this green candle as our entry point, knowing that our expectations are if it went from 41 down to 32, we'll call it, so maybe $9. So if we're entering here, we're thinking that around 41-ish up to about 50, we've still got plenty of time to participate in this particular rally. Again, the whole goal here is to find a trend and act on it before it is a mature trend that maybe has potential to turn around. So certainly if we're looking at the first bar pass and we're thinking 41 to 50, that's $9. And we're talking almost 20 to 25% return, plenty of time to act on that. The issue is that when traders try to react too soon and don't get that confirmation, that's when you get kind of whipsawed in those false breakouts. And so we try to avoid that by making sure we've got clearly defined levels of confirmation before we do get invested in these types of things. Doesn't mean you can't try to predict things, right, Andrew? You can certainly do that. But I would say if you're going to be doing that, make sure that you've got very firm risk parameters in place, knowing where that stop out level is so you don't get caught, as Andrew was showing us before, in a situation where you're saying maybe 450, maybe 350, maybe 250, and next thing you know, it's back below its pre-pandemic levels. So keep that in mind as well going forward with all of these patterns. Triple top, if we're talking about this isn't too much different than what we're talking about previously. What is the difference? Well, we've got an additional touch here on that particular line. So again, we're entering, and this one is a triple top, so we're entering from below. We hit that resistance line, back to support, resistance, and we got 3 touches on that particular resistance line. And then again, the same type of situation, right? We're getting that break of that support level, maybe a false breakout, and then now it turns into a resistance level, and now we're waiting for our particular signal. And again, not always clean in real life, right? But you can certainly see this triple top where it touches, touches, and touches. It doesn't quite make it all the way back to this lower level, but it does here, right? Now sets this particular line as the lowest level and a touch, and now here we are breaking through. Now, obviously on this particular one, if you weren't watching on an intraday basis, you might not have seen this particular breakout and you may not have acted on it. Next thing you know, we're well through it. And again, if we take the basic understanding of how to figure out what those levels should be, we'll call it 27 to roughly, we'll call it 25 half. So for this one, $1.50, well, that breaks that pretty quickly. And so this one might not be one you're acting on if you're into it a little bit late. But again, we want to make sure we understand what those breakout levels are and how we get that confirmation of that particular breakout. Of course, the opposite of that is going to be that triple bottom. And again, this is just the reverse of what we just looked at. We enter from above. We are down to the support line with three particular touches here. We have the resistance line in between. And then, of course, we have that breakout, once again, that resistance turning into a support line and understanding what that breakout looks like and what your parameters are for acting upon that. Now, I like this one because this is a particularly interesting way to look at it as well. We have that triple bottom, and now we've got this particular trend line that actually is a slanting trend line, which is completely fine to use, right? We don't always have to be horizontal. In fact, if we go back to that last slide, because that was an observation I was making on this last line in my head, is that really, if we take a look at this, we may have drawn this particular trend line right here, right? Sloping down from this point all the way down here. And now maybe we've got a slightly different feel for what that breakout is. And maybe that gives us a completely different signal as to whether or not we want to trade on that. So again, going back to that triple bottom, as you can see by this particular chart, we've got our three touches. We've got our downward sloping trend line this time with plenty of touches in between. And now we're looking for that breakout. Again, if you look at this first green candle, it maybe closes just outside of that trend line. And you gotta ask yourself, is that enough for me to be taking action? This particular next candle opens high, making you think that, well, that was the breakout, but only to retrace throughout the day and again close back below that trend line. The next candle to close above it is a few days later. So a lot of choppy action here that probably frustrated a lot of traders as they were trying to pick their situation and get involved. But certainly understanding what your particular levels look like will help you to avoid those type of incidents. So those are the tops and bottoms, those double and triple tops and bottoms. Anything you want to add to these, Andrew, before we move on to the next type of formation?
Yeah, it's so funny when we think about these horizontal congestion. So we have double top, we have triple top. How many times might we go through these numbers? Is there a quadruple top? Is there a quadruple bottom, quintuple, all of these things? And not quite. After three times, we simply just call it a rectangle. And after that is just simply called just simple digestive sideways price action. So eventually, that's kind of what we call the Russell. And when that example, that was just simply a rectangle. And what are we, getting from a narrative perspective? Again, that's the importance of these patterns is understanding really what's driving the pattern, that relationship of supply and demand and buyers and sellers. And the idea is that there's one maybe school of thought of indecision. They just simply don't know where that next kind of opportunity lies. They're waiting to see what happens next, but also equilibrium in the sense that buyers and sellers have mostly agreed to a price of sorts, and maybe that is still a large range, like we mentioned on that Russell. That was a 10% range. So 10% up or down, you could have been someone taking advantage of a component of the supply and demand levels. Imagine if you bought it, support, and sold at resistance. And again, sometimes that points to the idea of a breakout sometimes. Imagine if you regularly have bought at support, sold at resistance, maybe even went short at resistance and then bought it back at support. Imagine you do that a handful of times and then all of a sudden you find yourself on the wrong side of a trade when that breakout takes place, and you had been a short seller on that area of resistance. Then now we see breakouts to the upside. Those short sellers become forced buyers. So again, the squared rectangle and double top, double bottoms, they look at things through that idea of level supply and level demand. So what is the slight difference when we move from rectangles to triangles is rather than there being level supply and demand, there's accumulation or distribution, diagonal supply and demand, diagonal support and resistance. So a symmetrical triangle is just simply that component of where we see declining highs, but improving lows. In essence, lower highs and higher lows, meaning that sellers are being more willing to sell at lower prices, but buyers are being more willing to buy at higher prices when we get down to those levels. And the interesting part about a pattern like this is eventually there has to be a breakout. If we look at a rectangle, theoretically that could happen forever. It could go on to into perpetuity, just simply moving sideways. A triangle has to have some sort of breakout eventually because there is a converging line here. And does that mean that the breakout moves with significance? Not always, but there will be an actual breakout at some point in time. And that sometimes is what traders are ultimately looking out for. There's been one, kind of major name, if we go into the chart patterns over the last few years, that has had maybe a handful of different triangle periods on the chart, and that was Tesla. Tesla has had a remarkable amount of triangles throughout its tenure. If we say look at this level in particular as a good example, back in I believe this was 2020, maybe 2021, we saw, what do we see here? Higher lows but lower highs, and then when we broke out with significance. We saw a quick move to the upside. And then from there, too, you could argue, arguably, if we look at the entirety of these last 5 years, what does it kind of look like as we draw these lines on a chart? It is looking very much like a triangle of sorts. We can look at things through very short-term patterns as well as very long-term patterns. And I would imagine there are some traders, by all means, they may be trading the body of this triangle up and down, but there's probably a lot of traders waiting to see if we can break out of this pattern, or if this does continue to converge, what that will look like when this pattern has to be broken out of to some degree. Is that going to force certain buyers or certain sellers into the mix? So again, triangles are just an idea of consolidation within a specific range, but with that extra component of supply and demand. But very much like that Broadcom stock we just looked at, AVGO, it was what's called an ascending triangle that Albert mentioned. What is an ascending triangle? Well, rather than two trend lines kind of converging with one another, an uptrend and a downtrend line, what if we have rising demand but level supply, level resistance with diagonal support? That is an ascending triangle that we're seeing here. Essentially, sellers willing to sell at the exact same level, buyers willing to buy at incrementally higher levels. That is what this triangle in essence creates itself, and that's what we're looking for to see, is there a breakout. And an important thing, don't let the phrase ascending or what the next one we'll look at is a descending fool you, in the sense that an ascending breakout or ascending triangle breakout must be up. It can break out either direction. It can be an important component of essentially what a body wins in this case. Do bulls win or do bears win? Is there enough supply and demand overwhelming one another to create that next move? Sometimes it can be waiting to see what happens. We mentioned waiting for breakouts and things to that extent, but also we can see ultimately what it means as there is consolidation in the mix. I mentioned descending triangles, that next otherwise component of this. Again, the very similar. We have a downtrend line essentially selling at incrementally lower levels, but a level area of demand, a level area of support. Again, it does not mean that one breakout has to happen one or the other, but it does mean, imagine if you were someone who regularly bought at this level of support, and then every single time it goes up, you saw it get less and less profitable in your favor. First you buy it, let's call this $50, and it gets to $70. Next time you buy it, it only gets to $60. Next time you buy it, it only gets to $55. You probably get a little bit more and more nervous every time it gets to $50. You are a little bit less confident every single time it does that, because you're being rewarded less and less each time. So again, thinking of a narrative of what creates these breakouts, imagine buy at 50, see it go to 70. Buy at 50, see it go to 60. Buy at 50, see it go to 55. If that continues, do you feel quite as eager to buy it at 50 that fourth time around? If you're thinking, well, what if it only gets to $52 at this point? Or what if it goes down? So there's just not quite as much demand in these levels. But the other side, what if you see it shorting it along the way, and then all of a sudden you're in a red lack of profit loss trade? You are then forced to become a buyer to avoid any further upside risk. And sometimes that creates the breakout to the upside. And the last one on the triangle kind of scenario is what's called the wedge. What is a wedge? Well, it's very similar to a symmetrical triangle, but it's kind of happening within the confines of a trend, that the exponential component and how large this body is moving between the highs and the lows and the relationship of those two things is converging to some source. We're still getting higher highs, we're still getting higher lows, but those components are kind of converging in their own right. That's what we get by a wedge. Sometimes we then expect, as there's quicker movements to the downside as there is to the upside, sometimes just a lack of willing buyers when we get to the other side of the equation. Now, these are kind of the next few fun ones that I like to take a look at. These are a little bit different in their own right. This is sometimes what people have heard before, head and shoulders top. What is this? Well, Let's break it down again from the narrative component. What ultimately does make up a head and shoulders top? Well, it's a higher high, a higher high, and a lower high. So left shoulder, head, right shoulder, and there's a level of neckline there at the bottom end of the support. That is where you would anticipate that kind of final level of support to exist. But again, if we think about it from the narrative component, what does this kind of feel like? It feels like a rounding top style formation. Again, when we think about simple trend following strategies, we want to continue to see higher highs, higher highs, higher highs, maybe higher lows in between those things. The first time we see a lower high, that in and of itself is some sort of component of a warning sign that wants to be out there in the marketplace, that we did not see buyers pushing us up to those prior highs. We saw selling being willing to take it off the table. And that neckline represents that kind of, again, final line in the sand of support for the most part. So again, what do we generally see when we hear this out in the market? Well, what I often hear is what I always like to point out is one fallacy of this type of pattern approach is that we'll see a left shoulder, we'll see a head, and then we'll see some sort of topping pattern on the right shoulder side of the equation. Someone will say, oh, hey, that looks like a head and shoulders forming. But again, we want to be very cognizant of where is the breakout on the chart. For head and shoulders, the breakout is a break of the neckline, because imagine if it did not break here. Imagine if it bounced here and kept going up. What does that start to look like? It starts to look like a descending triangle. It starts to feel very much like a descending triangle as it would have otherwise, because we're seeing declining highs, we're seeing level demand at the bottom here. So that breakout to the downside is an important component of that. So, I mean, let's look at a few good examples of head and shoulders formations that we've had in the last few years. In fact, there's kind of two major ones that I like to take a look at over the last few years. Let's see if it still shows during this time frame in particular. Yeah, this was a good example here. So if we were looking at what the S&P 500 looked like during this topping formation of 2022. What did we see here? We saw a higher high, then we saw another higher high, and then we saw a lower high. And from there, you might have started to think, all right, well, that's a lower high. That's something to be cognizant of. But I think as long as we hold, probably call it 4,300, well, then we still probably feel okay about the general trend of this. And where did we kind of break down out of this? First, I guess maybe if you call it 4,200 here is probably a little bit better of a area on this one. 4,200 was that first major bounce back to this level. And then when we broke down to that, that was where we saw that movement to the downside. In fact, if we think about what is the measured move, I think we've kind of overlooked some of the measured moves here today. Well, there was about 600 points of movement between these two levels. If we then move 600 points from this breakout, where would that take us? It would have taken us roughly to this level in particular. We roughly got to the exact level you would expect to find on a breakout of a head and shoulder style formation. And then from there, that neckline ended up being resistance for a bit of time. You'll notice it took us a while really to get back above 4,200. And that's also where we flipped that resistance into support at the end of 2023. Another good example of a head and shoulder style formation. Coincidentally enough, Tesla. If we look at kind of what we've seen here, maybe a little bit more complex. Sometimes we think about head and shoulders as a perfect two-shouldered system and a perfect head. Sometimes there is that component of what we see here. Of course, we see a very prominent high here. And then from here, maybe we see a handful of highs, but you could also just think about this range as some sort of high on its own, maybe then this being a lower high, and then as well as where we've been recently. And then from that perspective, where was the important line in the sand? It was really about at $200. So $400 to $200 is a pretty decent move. And you wouldn't expect to take $200, subtract 200 and say Tesla is going to zero because of that. But maybe you think, well, if it lost 50% from this head to neckline, what if it loses 50% again? Where did we then get down to on the breakout of this style formation? We got right down to about $100. $100 was another 50% move to the downside. So another kind of example of head and shoulders top playing out well. Now, at this point in time, we really haven't been able to get above that neckline here recently. Or of course, we did, and now we're back below it to some degree. So it definitely just depends on what time frame that we are using. But at the end of the day, it's about painting the narrative of what buyers and sellers are doing at different points in time. We also generally look at the inverse of that, the inverse head and shoulders being another example. Instead of higher high, lower high, it is lower low, higher low. Again, what does that mean? It's just the kind of flip and paradigm shift of the market at an important juncture. Where we have been seeing distribution, we see that of accumulation. That first higher low is an important component of the broad markets in that same degree. Coincidentally enough, what did we get on, say, the S&P 500 coming out of that head and shoulders top? Well, what does this level at this moment in time kind of look like? We see a lower low, a lower low, and then a series of higher lows. And funny enough, and we also considered that, say, 4,200 level as that component of a neckline, or maybe we call it roughly right here, 4,300. Well, we had about an 800 point differential between that. And we have since then taken off well in excess of that level in particular. Pretty much call it this topping area was the projected move of that inverse head and shoulder. So we get funny components of things like this from time to time, even on broad indices. And the component of this is simply a psychological observation of the broad markets, is that people are naturally going to react according to what price action is doing. If you are someone who's had something long and you start to see distribution, you're naturally going to become a little bit nervous out there in the marketplace, and you're going to take action at levels that seem intuitive to the human component of that as well. Round numbers, there's a reason that things happen from time to time at round numbers. It's not because the company's price to earnings ratio got perfect at that level. It's not because the EBITDA got perfect at that round level. It's because a round level is an easy inventory that we can keep on our own relative to what is happening. When we get to 4,800, 4,000, 5,000, those are round numbers that we have in our head that we can keep an eye out on from that perspective. Last one I want to take a look at before I pass back over to you here, Albert. Another type of pattern, but this one's slightly different, what's called a continuation pattern. So what does that mean? Well, this one's a cup and handle. This one's very complex. You don't see them happen too often because it requires a decent amount of price action to see a very cup and handle style pattern, where we see a long period of time where we see somewhat of a rounding base, meaning that we saw distribution, we start to see accumulation, we get back to those prior highs, we see a little bit of consolidation before being able to break out of this. In essence, creating a cup with its little handle, call it a cup and handle style formation. Where have we seen that recently? Coincidentally enough, on a couple of major names as far as the market is concerned, excuse me. Where did we see this almost perfectly? On Microsoft. Microsoft had a kind of perfect cup and handle style pattern during this last run up here. Now, I can't draw a curved line on Active Trader Pro, but I mean, just being able to squint our eyes for a brief moment, you can see what that rounding style formation is. And when we got back to the prior highs from those 2022 timeframes, or I think 2021, we saw a short period of downside consolidation. And when we broke out of that, it was again kind of off to the races in that respect. We got back above this 350 level. We've since moved 100 points from that period of time. Let's take what the difference is between the highs here. Call it, was this about 37%? Moved to the upside here, we have moved about 27%. So we've seen a decent amount of the extension of this. Actually, sorry, I'm drawing off the wrong levels here. You could call it probably this breakout here as well, that we've seen most of that move from the cup and handle style pattern. In fact, too, we saw essentially the same style formation on the NASDAQ. The only difference was that perfection of getting to the exact level that we were at beforehand was not quite there. We kind of saw a diagonal trend line here. Maybe you call it that level, maybe you call it this level. Nonetheless, we saw a rounding pattern going into the event, short-term consolidation when it was retested, and then a quick move above that when it got out of that level, in particular, a breakout of sorts. So that was most of the patterns that we wanted to get through here today. Anything you wanted to add to these patterns, Albert? Any questions that you saw come in?
Yeah, again, it's just these are the kind of ways that we can relate to each other as traders and technical analysts, right? We can talk about these types of patterns, and again, we can look at these things and see different things. You can certainly see how you can make a case for a cup and handle here. Somebody might be a little more rigid with their definitions of what it looks like, and maybe they'd argue that maybe this isn't a rounding bottom kind of situation, and that's fine. The goal here is to at least be able to relate to each other and talk to each other on a level that everyone understands and certainly can see those type of patterns developing. So the question then becomes, how do we do this? How do we take all of this information, and then what do we do with regards to actually trading these types of things? So I think that if we take a look at the next slide here, we can talk about trading with patterns. And, again, the issue here is that we're taking a look at this particular pattern. We've seen this kind of consolidation, and now we're taking a look at what we think might be happening next. We get maybe this green candle, maybe this is our confirmation of that breakout, and we get involved. So we buy our situation right here with a stop. below it, knowing that if it breaks back into this pattern, it could certainly go quite a ways back down to this side, and potentially even maybe this is a triple top, then maybe go back the opposite direction. So we've got our stop set right here in order to protect us from that downside. But wouldn't you know it, things start to trade up and start to do quite well. Next thing you know, we've got new triangle pattern, right? The symmetrical triangle pattern where the upper line is sloping downward, the bottom trend line is sloping upward and coming to a point. So now we're looking for that kind of breakout from this level. What do we want to do? We want to see get that confirmation. We see it here. We put our stop maybe below on the other trend line, knowing that if it gets back down, maybe this is a false and it goes back the opposite direction. Again, protecting ourselves from that downside. But what you know it, we're doing well again. It sticks to that kind of upward sloping pattern. And now we get ourselves into another triangle. So it's same as the first time, right? We're waiting for that confirmation, that breakout of this particular symmetrical pattern, looking for it to give us a signal as to what our action should be. We get that action again, breaking out. We set another buy, again, setting our stop here below in case this is a false breakout. It starts to move back below from this particular level. And again, working our way higher. This time we look in more of a wedge type of pattern where you have both the lines sloping upward, maybe less of a triangle because it's not quite as steep, but nonetheless, we see that back and forth pattern. Again, looking for that breakout. We get that here. Our stop is set right here at the edge of that particular wedge that we just got through. And what do you know? We're into another pattern, right? So as you can see, these things start to build on each other, and we start to build up this sort of narrative of what's been happening with this particular stock. Well, we don't even know what stock this is, but we can see it's had a tremendous run and a couple of consolidation periods where those buyers and sellers are kind of battling it out. And as Robert always likes to say, let them fight it out. I'll join the winning side when it kind of clarifies itself. And that's what we're doing, right? We're letting those buyers and sellers kind of battle it out. And once we get a clear an idea of what we think the direction is going to be based on our parameters of what a breakout should look like, then we get involved. But knowing that we're getting involved in a pattern that potentially could be a false breakout, it might not be the right pattern. We also have those stops in place, right? We've got our exits ready to go in case things don't work out the way we had hoped they would. And we just kind of continue to follow that up and follow it up until eventually we get to a situation where, yeah, we'll add one more time with our stop in place. Well, wouldn't you know it, that's kind of the end of that kind of road for now, at least. And it comes back through. Now we get our stop out right here. And then we can see a little bit of chaos back and forth and tries to go higher again. But now we've got an additional, maybe we got a double top forming here, right? And so maybe we've got this double top forming right here. And now we've got a different thesis going forward. Maybe we're now looking for some sort of short entry if this completes that pattern as well and gives us the confirmation we're looking for. So again, it doesn't mean we got to trade just one pattern. We can stack patterns on top of each other and kind of had this narrative running forward and staying involved in a particular trade, as long as we are getting the signals that we need to see. And as long as we have those protective stops or those exits in mind, knowing that if the pattern doesn't do what we think it's going to do, we are out of that particular trade, right? The goal here, of course, is to get to a point where we can make this as mechanical as possible. We don't want to get emotions involved. And again, to reiterate what Andrew was talking about previously with that Zoom chart, we don't want to keep moving the goal line. Oh, wait, I'm sorry. The Yosemite Sam line, I think, is what we're referring to it to as. We don't want to keep moving that line and fall off the cliff, right? Because that's how we end up being unsuccessful as traders. We're going to take losses. That's just the name of the game. The idea is to control those losses so that when we do get winners like this, we let them run. And of course, that outweighs any of those smaller losses. All right, so let's move to the next slide here. Best multi-pattern bars for upward signals. Again, this is based on a lot of research, right? In other words, people have gone through and done tremendous amounts of research about these patterns to try and see if they could figure out, what one might be worth more than the other, which one has the best track record, right? The most wins, things of that nature. And so this is kind of the boiled down into what they found to be some of the most successful. On an upward single, they see that those descending triangles, again, remember that descending triangle is the one with the horizontal lower bound and a downward sloping upper bound, and the breakout of those tend to be very profitable. A rectangle breakout, now not specifying up or down, but after a period of A long consolidation might be an opportunity for us to see breakout in one direction or the other. And so we're aware of that. A pipe bottom is simply a stock that has a lower close and then a lower open the next day, and then potentially moving back and being a reversal type situation. So this is again is like a two bar, two open high, low close bar type signal. Downward signals. Well, certainly those flags, those short terms that we were showing you, not too dissimilar to the triangles we just talked about. The head and shoulders top, I believe, Andrew, and correct me if I'm wrong, I believe that based on the research they did, this is one of the most profitable patterns of all of them, although they don't occur as often as some of the other ones. But if you do see it, there's a good chance that it's going to be one of the better signals you might get on a particular stock. And then the island reversal is simply, getting back to kind of that get idea of gaps and filling gaps after a stock has had a tremendous move. So these are some of the multi-bar patterns that some of the top traders have gone and researched and said that, hey, these are some of the most reliable patterns that you can find. So kind of search these out and see if we find those, and then maybe have a bit more confidence, or maybe you have. If you see it a few times work out, maybe you've got a bit more confidence. Maybe you have a slightly more or less restrictive breakout definition on some of these patterns. That could be very possible too. It doesn't mean, of course, that they are going to continue to be extremely profitable, or even profitable for that matter. Certainly anything can be subject to a false breakout or false narratives, especially in today's environment where we have a lot of eyes on things, a lot of computer eyes on things too, right? But keep an eye out for these particular patterns. Anything I missed here? Anything you want to add to this particular part, Andrew?
Yeah, so one third-party resource, and of course, with that, keeping in mind it is a third-party resource, but Charles Bukowski was a kind of foremost author of these back-tested patterns, and he runs a website called simply The Pattern Site. It is a somewhat rudimentary website. It feels like it was built in the early 2000s and never updated, but nonetheless does give all of the back-tested information relevant to some of these patterns. And I think one thing that is valuable is that if you are looking at a pattern that you observed in the marketplace, well, one, sometimes I'll just simply go look on the pattern site, see what the general percentage expectations were of these, and you'd be surprised how sometimes, more often than not, they amount to very close to a coin's flip chance. So don't read too much into these patterns. Of course, on a long term, law of large numbers, if you're running something that has a 55% chance versus a 45% chance, well, maybe we feel pretty good about that. But for one trade in particular, that might not make a big enough difference as that 5% edge relative to that. Sometimes it is the component of combining other pieces of information and technical analysis. In fact, I saw someone asking in the chat, how do you feel about using RSI or simple moving averages for confirmation? I think there's a value to that by all means, in the sense that if we see something happening on better or worse momentum, or components of that, maybe that gives us a little bit more confidence in what is happening in the market at that moment in time. I think there's always somewhat of a value of what I like to call a confluence of evidence. If we go back, say, to the S&P 500, let me pull that back up here for going back a decent amount of time. If we go back to, say, this level in particular, this one that we find here, in fact, let me pull this up on a daily chart. When we were retreating and finding a bull or bear market rally back to this level, what could have made us more confident that it was going to fail at that 200-day moving average? Not by any means does it have to turn around at a 200-day moving average, but that level in particular, 200-day moving average, that was one idea of resistance. Another idea of resistance, this has been roughly where we found support going into these levels. What was another idea of kind of this being more bearish than bullish? Well, at that moment in time, RSI had just become overbought as far as RSI is concerned. And at that moment in time, a Bollinger Band found us right at the edge of that Bollinger Band. Does that mean, on their own, all of those signals were bearish signals, meaning that we had to turn around at that level? No. Just there was enough confluence of evidence that, imagine if you were thinking, do I want to be a buyer here? Maybe not. Maybe I want to see if it can get above the 200-day moving average, get above this level of resistance, cool off on the momentum a little bit, and I'll wait to see if there's a better opportunity at that moment in time. Or if you have been someone who bought it maybe above that 50-day moving average and now you've seen it get here, maybe you take some position off the table, maybe you do some stock replacement strategies. It just means that there was more of a confluence of evidence against the bullish thesis. And that sometimes in and of itself is enough of a component of what we're looking at in scenarios like that. So again, it is just a way of taking the approach of what we think is going to happen at any given moment in time. And To the question I got, or we got at the beginning of this session, let me see what the exact phrasing of that was. How would we know that there is a breakout? We wouldn't. That's the interesting thing about technical analysis. We never know what is going to happen next. It is simply just taking a position where we feel like the probability of distributions is slightly more in our favor. If you can assign where do you think is there a better chance it goes up, a better chance it goes down, a better chance it moves sideways, we just want to position ourselves to try to take advantage of what we believe the outlook is to be. But in that same scenario, if we go back to that Russell example, this level in particular, well, maybe simply at that moment in time, you're thinking, well, hey, if it gets above 2350, I'll be long and I'll wait until that's the case. And for years almost, or a year almost, it didn't get above that case, and we got above it. We got 100 points, and then it didn't keep going. We just didn't continuation. Maybe then you could just be a seller once that bullish thesis was invalidated. We can be protective. Sometimes what is that issue with a failed breakout is the simple nature of what we mentioned at the onset of this class, is that we see a failed breakout and then people don't close the position. They start looking for a new area of risk management, even though their original bullish thesis had become invalidated. So I think that's the biggest component for that, is have an area where your thesis is no longer valid. Always ask ourselves, if we did not have a position on currently, would we put that position on given the information we know that day? That can work not just from the perspective of risk management on the downside. I can also work from risk management on the upside. If you were thinking a position that has moved significantly higher in your favor, ask yourself, hey, if I didn't have this position, would I buy it today? Would I buy it at this level that it's at today? And if the answer is no, well, other people might be coming to that same conclusion. They might be willing sellers, or at the very least, there just might be the kind of displacement of buyers. Buyers are no longer around at these higher prices, and they become willing sellers, and that kind of chase for the exit starts to begin. And that's the main thing you want to try to avoid, is being the last one holding that kind of musical chairs when the music stops sort of element. You don't want to be the last one holding the position, even though those other people have kind of raced to the exits. But I know we're kind of approaching the last few minutes here. Anything you wanted to add, Albert, before we wrap up?
Yeah, the one thing I do want to add is that, as we look at technical analysis and as we think about the ways we analyze certain situations, there is nothing that says you have to be strictly using technical analysis and chart patterns as your guide, right? We can certainly combine the two and come up with different ideas. One of the things I always like to talk about is the fact that we can look at technical analysis, but if we're headed into a binary event, it might not do us any good to try to analyze where potentially we could be after that, because we don't know, right? We can look at any one of the big earnings that have come out. We can certainly look at Nvidia for positive earnings surprise, but we may have looked at Nvidia's chart heading into that and saying, hey, listen, if I'm looking at this particular chart, this to me looks like maybe things are setting up for some type of movement. Maybe I've got profits built in, and maybe I want to protect myself. Obviously, not knowing what that result is going to be going forward. Maybe that chart pattern or maybe something gives us a clue is that to maybe we should take something off the table prior to this binary event, because the binary event itself can wreck a chart pattern, right, Andrew? It could completely gap up or down and destroy everything that you've been looking at for the last 3 or 6 months or whatever. And now we're starting a whole new process looking at this new pattern that's been developed by this particular situation when those earnings come out, or whatever that situation may be. So keep that in mind as well. Just understand that there are events there, those binary events such as earnings, that could certainly blow up a chart that you've been looking at and really kind of blow things out of proportion. So it can help us to understand maybe the risk heading into that particular situation, and maybe help us to understand whether or not we want to be involved for that particular binary situation, because it could change things very drastically going forward. But I think that kind of getting back to the original question that Cliff had was, do you like RSI and SMAs? I think the answer is whatever you're comfortable with, right? The whole goal is for you to be comfortable reading and understanding the signals that you're seeing. And Andrew said it perfectly. It's that confluence of things coming together to give you that signal. And if you can get 3 or 4 that are looking at the same direction, again, doesn't mean it's necessarily going to be right, but it can give you that confidence to go ahead and maybe take that action that you were thinking about with regards to the trade. Now, obviously, there's always going to be those false breakouts and things of that nature, but the more things we get pointed in the same direction, the more comfortable we can feel about it as traders going forward. So that's really the kind of takeaway I would say, is that we're looking at chart patterns today. Patterns in and of themselves can be very useful as a tool. It doesn't mean they can't have false readings or give us false readings. They're certainly not predictive, but they're going to give us an idea of what we can expect to happen. And if we can get other things lined up that are maybe pointing in the same direction, we can get that sort of comfort. It doesn't mean we can't trade that pattern. It just means that if we don't have that comfort, maybe our risk parameters are a little bit tighter. If we get three or four things pointing in the same direction, maybe we're a little bit looser with it, right? We can always change that depending on what that situation is. But certainly understanding the chart patterns is just a great starting point to help you with your analysis going forward.
Yeah, I couldn't agree more. At the end of the day, we are always just simply trying to find some sort of evidence of what or where the best place to park our capital is in a given period of time. Sometimes it's cash, sometimes it's a market, sometimes it's stock, ETFs. We're just simply trying to find where the best place to park our individual capital is for that given period of time relevant to our risk and reward tolerance. And we're trying to find a way of substantiating that through our own component of risk management, through our own component of observations, and our own kind of outlook of what different things are happening at different points in time. So as always, appreciate everyone joining us here today. Plenty of fun things that we talk about. This was, like we mentioned, week 4 of the Technical Analysis weekly classroom series. I'll show that one more time actually on fidelity.com. Let me pull this up for a brief moment here. So when you go to fidelity.com, in fact, if you pull up the strategy desk classes, if you go to the technical analysis classroom, this is going to be that week 4 slide deck. In fact, it might just be all one slide deck at this moment in time. So if you go to the download slides, it is going to be all 4 weeks jam-packed into one document. But if you go down to the bottom, this is where you'll find all of this, as well as some candlestick patterns that are in the other part of the chart as well, or part of the deck as well. So again, appreciate everyone joining us here. We'll be back in about a half hour for our afternoon market briefing. Do appreciate everyone joining us here as always. Look forward to seeing everyone in these future sessions and hope everyone has a great rest of their day. Take care.